Rotary Foundation is helping Rotarians not only with Rotary service, but something you probably don't even realize. The Rotary Foundation is helping with personal tax, estate, and legacy planning. To understand, we have to discuss two unpleasant topics: death and taxes. What are the charitable giving options in the United States? And then, why does the U.S. government support charitable giving? Why do they give up taxes in order to give you a tax deduction for charitable giving? And we're going to talk about three seldom discussed donation options: the donor advised fund, the charitable annuities, and the personalized named endowment fund. To understand the three options, you need to see the impact of taxes. The U.S. tax system is a multi-purpose tax system. Of course, is to collect taxes, but also the income tax system gives the government the indirect control over privately owned wealth in order to accomplish certain economic and social objectives. Someone once said, "I would rather control something, an asset, than I would to own it." You think about that one. The estate tax system is used to limit wealth, so that wealth and the power that comes with it is not in the hands of just a few multi-generational families. Let's take a look at this chart. When the tax system started in 1913, the tax rate was 7%, and the senators at that time says, "Oh, it'll never go past 10. Well, guess what? It helped finance World War I. The tax rates went up as high as 75%. Then it went back down. Then it came back up during the Depression, and during World War II, it hit the highest at 92%. What was the objective? Well, it's what we call top-down economic system. It was a 55-year test period. The United States had not ever done anything of this nature. But basically it said, hey, we're going to tax you at a very, very, very high tax rate unless you invest your money and earn money doing something that we need you to do. For example, during World War II, they needed investments in the war efforts. So if you would invest in the war effort, you wouldn't pay 92% on your profits. No, you would pay something more like 28%. Then what happened was Reagan and Tip O'Neill came along in the 1980s, and they put their heads together and they says, you know, there's a lot of problems with this system we've got going, because over this 55 years, all of these people have gone to Congress and lobbied their congressmen, and there's all kinds of tax shelters out there now to protect people from this 92% tax. And a lot of these shelters are not good for the economy. They're a distortion of our wealth and our assets. So let's not do this anymore. Let's do a bottoms-up approach. Since the rich are only paying 28% on the average, even though the tax rate is 92 because of the tax shelters, let's do away with the tax shelters and let these people invest the money as how they see best fit. Bottoms-up economics. Of course, the political opponents came in and says, oh, this is trickle-down economics. It doesn't work. It's bad. So they were able to raise the rates up to 39.6. Currently, it's at 37. President Biden wants to move it back up to 39.6. Even higher than that. He wants to eliminate capital gains tax and so forth. So what we have today is kind of a mixed bottoms-up, top-down economy. Let's see where it goes in the future. We don't know. And frankly, we don't care. I just needed you to know a little bit about the tax system and what they're trying to really do. They're not trying to collect 92% tax. What they're trying to do is tell you how to invest your money. We're only going to look at the gold line, the top line of this chart. This represents the top 10% wealthiest people in America and how much of the wealth in America that they owned. You notice when the chart starts in 1910, they owned a little over 80% of the wealth in America. Once the estate tax system was instituted, their share of the wealth dropped from 80-some-odd% to roughly 65%. Then as time passed, it's gone back up where the top 10% of wealthiest people in America own about 70% of the wealth in America. Still better than 1910, but higher than a lot of people want to see. I put this little chart in just to remind you that taxes are going up. Not that they necessarily want to collect more taxes, though they do, but they also want to tell you where to invest your money, and they want to make sure that certain other things are accomplished. Here's another chart for us to look at. Under current law, $11,700,000 of an estate passes tax-free to the heirs. Anything over that is 40%. There's also what they call a step-up in basis. I'm not going to explain it, but Biden wants to change that, eliminate it. And so the point is under current law, unless pensions are involved, up to $11,700,000 could pass income tax and estate tax free to your heirs. Under the Biden proposal, things are going to change radically. Under my calculations, approximately as much as 73% could be taken by the government and 27% passed to the family. Now, if you went to see your attorney and the attorney said, oh, by the way, 60% or 65 or 70% of your estate's going to go to the government, whereas last year nothing was going to the government, what would you say? Well, wouldn't you say, what can I do? I'm saying that this will prompt action. When the government wants more of something, what action do they take? They increase tax rates, just like we saw, and they offer tax reduction incentives. They're not necessarily trying to collect more taxes. What they're trying to do is to encourage taxpayers to take action. Rotarians have 5 options to donate to the Rotary Foundation. The first, which is so very important, is the annual fund. It's the backbone that funds our year-to-year service. If we do anything, we need to at least make donations of 100 or 1,000, as much as we can, to the annual fund every year. Then the polio fund, and what we're going to be talking about today, the donor advised fund, the annuities, and the personalized named endowments. They help 3 parties. They help the government, they help the Rotarians, and they help the Rotary Foundation. So let's explore this. Number 1 is the donor advised fund. Donor advised funds are for the not so wealthy. The wealthy don't need it. The poor are too poor to afford it. So it's for the middle class wealthy. And let me tell you how it works. 81% of Americans cannot deduct their contributions. Why? Because of the high standard deduction. Now, don't throw eggs at it, because that's not a bad thing. Suppose that you had charitable deductions of, say, $15,000, and then you had your property taxes and other deductions, and it added up to be just, say, $1 short of the standard deduction. That means you got the whole amount that you paid plus $1 extra, because the standard deduction was $1 or higher. But what if you prepaid next year's charitable contributions of $15,000? Then that means that this year you would get the standard deduction plus $14,999 extra tax deduction. So the objective is to allow a tax deduction for amounts in excess of the standard deduction. It's a good deal. Let's go on. What's in it for Rotarians? Well, what if there was a box on your tax return where you can move some of your tax money from government operations to some other social need that you were interested in? All you got to do is check that box. Would you do it? Here's how she works. You make the donation. It can be in cash or other assets. If you have appreciated assets, then you'll be better off to donate appreciated assets. Let me give you an example. Suppose that you had a piece of land that you paid $200 an acre for, and now it's worth $20,000 an acre. Wow, what an increase in gain. If you were to sell that asset, you're going to pay a lot of taxes. So avoid the tax. You don't have to, government doesn't want you to pay it. If you'll give the land to the charity sells the land, then you don't have to pay the capital gains. You don't have to pay it. Plus, they're going to give you a full tax deduction for the fair market value of the asset that you put in. Wow, what a tax savings. And number 2, you receive that tax deduction when you make the gift. And number 3 is, over the future years, you advise the donor advise on how to distribute the funds. You tell them which charities to give the money to. This is a deal for the middle class. Next, we'll talk about charity-provided annuities. Annuities provided by charities are for those who want to donate but need the assets. They're just unwilling to let it go. Most often it's because they need it to generate income, maybe for retirement. A potential solution: buy an annuity from the charity. Take a tax deduction now. Receive an income for life of one person or two people. Receive major donor credit to allow you to become a major donor with the Rotary Foundation or a member of the Arch Clump Society. And anything left over in the annuity that was not paid out to you during your life would be deposited into what's called an endowment account, and we're going to explain that in just a moment, but this would be your named endowment account. Hold on. Let's explain endowment accounts in just a minute. But first, let me give you an example. This is something that my wife and I did a few years ago. It was a $50,000 contribution. So we bought an annuity, a charitable annuity. All right. We received a $22,000 tax deduction. And we received a life income of $2,850. Not bad. Also, we said to the foundation, whatever's left in our account, and the IRS think it's going to be about $22,000. The foundation thinks it's going to be about $25,000. So whatever that amount is that's really there, it goes into our endowment account, which we'll talk about in a minute, which will strengthen our Rotary community and the community in which we lived. We like that. So let's talk about the endowments, since I've mentioned them so much. They help three participants: Rotarians, the Rotary Foundation, and the government. Hey, three parties, three winners. So how does each one benefit? Helping Rotarians. Rotarians achieve current financial objectives. They manage their tax obligations so they're not paying so much to the government. They have more impact on their community for charity services that they're helping finance. And they're building, establishing their life's legacy, a financial legacy that will continue beyond their life. They're helping the Rotary Foundation. They assure the future of Rotary service as we're able to fund this endowment. And they're helping the government fulfill their duties to govern. This allows for private wealth to provide charitable services to society. The government doesn't want to do it all. The government can't afford to do it all. Private charities are much more efficient than the government. This is what the government wants for good reason. So just what is an endowment in a nutshell? It's an investment fund of a charity. The donations are not spent, but rather are invested, and the earnings are dispersed annually for the service of the charity, and some is retained to maintain purchasing power, to keep up with inflation, and it provides a reliable, steady income to the charity forever. Do you know that Harvard University, as an example, has $40 billion in their endowment? You can see them. It's endless. All the charities virtually have one. Well, in the past, only the wealthy could have financial legacy via a foundation. Why? They're so blooming expensive. They cost a lot of money to set up, and then the maintenance cost was heavy. And you had all kind of risk. You had to deal with the IRS audits. You had to deal with vendors. You had to deal with people you were serving, possible lawsuits. You got lawyers and CPAs. You got huge administration costs. But now, today, most anyone can have a financial legacy via a foundation through the Rotary Foundation. The alternative to expensive foundations are personalized named funds. Let me show you how it works. The endowment fund of Rotary or any other charity can have endless personalized named accounts. So here's the endowment at Rotary, and these are the accounts. Forever generating distributions for Rotary Club's service projects from the personal legacy funds of individuals who had the forethought to want to do good forever. Impact. Suppose that Our Rotarians in District 589 donated $10 million to their endowment funds, to their legacy funds over the next 5 or 10 years. Then at a 5% distribution, which might be an average distribution over a 20-year period, it would generate $500,000. The money is spent by the Rotary clubs, not the trustees, not the district governor. It's spent by the Rotarians and the Rotary clubs when the clubs apply for grants from the district and world funds. In this case, that's $250,000 for the clubs to spend via the district, and $250,000 for the clubs to spend via the World Fund when they apply for international grants. Wow, think of that. Well, nearly anyone can establish a named fund. Young, old, poor, rich, fund it during life, or if you don't have the money, fund it at the end of life. Let's look at funding it during life. Usually this is a special event or a reason. For example, you plan to sell a capital asset. Well, especially under the Biden administration, this could result in a tax as high as 44%. And if you happen to die before you sell the asset, it could be as much as 73%. So you could sell the asset during life and you would pay no taxes on the capital gain, and you would get a full tax deduction for your donation. Wow, that is a huge incentive. Or you could maybe want to memorialize the life of a loved one who's passed away, someone who lived a life of service and sharing, a Rotarian that really believed in that, and that was their value system. And that loved one of yours, you can memorialize their name by building a big statue, or you could take some money and put it into an endowment fund and memorialize their name, their history, their value system, their life through the Rotary Foundation by providing funds to fund Rotary Club service projects endlessly. You set an example for others to give back by giving forward, or maybe to support your favorite Rotary Club service type program. Or maybe just, it's very simple, you want to create your life's financial legacy. So at the end of life, what can you do? Well, first you've got to make plans during life to fund the end of life. So life insurance policy beneficiary, or a bequest from your estate, or gifts from a pension account or an IRA at your demise. Well, most Rotarians are in Rotary for fellowship, friendship, service, but someday our physical ability to serve will come to an end. Death will stop your personal service. But with a named endowment fund, death does not have to stop your life's good works. You can continue to live a second life of financial service. Set up your own personalized named endowment fund. And for every $25,000 contributed, it can generate as much as $100,000 or even more in your second lifetime of doing good. Plus it continues forever. Now tell me that doesn't feel good. All of us need to ask this question. At the end of life, will your life have been just footprints in the sand that wash away with the next tide? Or will you leave a lasting legacy, passing on your values such as sharing, such as love, such as service above self? Through the Rotary Foundation, living a second financial life of service, financially supporting Rotary humanitarian service programs, and promoting peace as we give grants to students to study abroad, all improving the human condition. When you participate in the funds of the Rotary Foundation, it will help you become the person that you want to be. It will leave your mark. It will create your legacy. I would be happy to meet with you, your spouse, and your financial advisors to help you determine if any of these tools available within the Rotary Foundation match with your goals and objectives. Do they work with you and what you need? Here is my contact information. Also, if you want to see this video again, this presentation again, then the YouTube information is on this page. So take a moment and write it down.
Your legacy, Rotary's promise. Leave the future behind, as this grandfather is doing, planting an apple tree with his 2 grandchildren. This year, next year, the next, there will not be any fruit. However, by the time these children are adults, they will benefit from the fruits. Leave the future behind with your legacy endowment with the Rotary Foundation. And through your financial legacy, enable Rotary service now and forever.